What happened here? Why is that doing that? Who's Alonzo?
Randy, Cyrus.
That's it.
Need to remind elders, the elders with business to jump on. All right, let's get started. What's going on, Cody? What's going on, guys? How you doing, bud?
It's 2020.
All right, today I'm going to go over investments. What about investment? Compared, again, of course, you know, to the infamous worst product ever, IUL. Right? All right. All right, here we go, guys. So today, I'm going to go over the comparisons to, you know how in the business, in IUL plans, they talk about you have zero loss, right? You can't lose. You guys ever hear that before?
Yeah.
Yeah. All right. I'll wait for everybody to get settled in. You ready? Oh, for Johnny. Wait for Johnny. Get ready. You got it, bro. All right. Okay, so when you invest, guys, there's fluctuations in the market, right? We know that, right? True or not, right? Market goes up, market goes down. If we look at how the market does here, you see it like today. It says the Dow hits a record high and then falls 500 points, right? And you see the ups and downs of the market consistently every day, right? If you look at it on a shorter period of time, this is the index, right? Today, that's how it looks. In a week, this is how it looked, right? You see so many variations. It goes up and then down, and up and then down, and up and down, and you're going to see that consistently. The market doesn't go in a straight line upward. It goes upward in a jagged line, up and down, okay? And no matter what company that is, you got Apple, an example, right? If you go in a month time frame, 3 months time frame, 6 months, you see it more, right? You see more variations of how the market performs, right? Our company itself, PRI, right? You know, in 6 month time frame, 3 month time frame, and 1 month time frame, in a 1 week time frame, you see variations, but overall, in a long period of time, you see the growth of the companies, right? Have I shown you? Let's take a look at Amazon, right? Amazon in one month time frame, 3 month time frame, 1 week time frame, right? Now listen to this, okay? I'm showing you guys this for example, okay? Google, right? You go to 1 week time frame, 1 day, 1 month, so 3 months, 6 months, 1 year, year to date. overall, right? 1 year, 2 year, 5 year, 10 year. Every investment, long term, has an upward trajectory. True or not? It goes up. Okay. So investments, are they supposed to be looked at short term or long term?
Long term.
Long term. Long term. You can never, ever, ever determine an investment based on a short term basis. How it performed in a week, a day, a month, even a year is too little a time frame. You should look at investment in 5 year, 10 year, 20 year, 30 year increments, right? As far as time. Okay. So that's where you're truly going to get the how a fund performs. Okay. And the reason I'm sharing that with you is because an IUL has a, what do they call it? When they say you don't lose. Yeah, but what's a word they use? Two.
Fixed rate.
Nope. It's not a fixed rate in their mind, right? No. When I'm explaining losses, see, you guys gotta learn the legal of IUL, guys. How do they use this when you have no guarantee to lose? The floor. Floor, meaning that it won't go past 0. Okay? So if the market does -20, right, they will get 0. Okay? Now, I'm going to ask you guys a question. You guys are going to respond to it. You guys are going to respond correctly, but I'm going to ask you to explain it. Is that a good thing or a bad thing? To get 0.
Bad.
No. It's a good thing. Good. Okay. That's wrong. That's wrong. Anybody on Zoom?
Well, it's a bad thing.
Why?
Bad.
Because there's no negative numbers to buy cheaper stock or cheaper whatever product.
That's what it is. It's called opportunity cost. Right? So when the market goes down, you lose on. Yeah, you might not lose in the dollar amount, but you're losing in what's something called opportunity cost. Opportunity cost is you're not getting a chance to buy the stocks at the cheapest time possible. At the cheapest time possible. Okay. Okay. Jay, while you're here, can you Google this for me? In a portfolio, how much of the growth is comprised from dividends? Okay. Why he does that? Okay. So so when you don't get less than 0, and you are in the ages, let's say your age is 30, in the 30s, 40s, or even in the 50s, right? This is your age, right? Obviously, you still have time to recover. Here you have what? 35 years to recover, 25 years to recover, 15 years to recover. That's plenty of time to have your money still recover in case the market takes a dip. Now, obviously, of course, when you are younger on this side, right? Look at this as heavy stocks over here, bonds, and cash. That's kind of how you want to be comprised of, right? The older you get, right, the more bond, stock, cash you're going to have. The younger you are, more stocks, or what they call it, equities. Okay. Now, what does it say?
No set answer.
What does it say?
No, there's no answer. I don't have an answer. Like it's just
A portfolio's dividends make
it's giving me portfolio. It's offering me portfolios.
How did you word the question?
Same way. In portfolio, how much is growth comprised from dividends?
What does it say? Anything? Investopedia? What does it say?
No. I'll look.
I think it's 20% of the portfolio's assets will be comprised of dividends. Why is that important? Because in a whole life for IUL, they don't pay dividends. So you lost all that money, all that growth, because you're not getting dividends in any whole life policy or IUL. Okay, so dividends is now what is a dividend again? In an investment, yes, it's not return of profit, life insurance. But in an investment, it's not return of profit, it's just profit. Because you're not returning profit. It's just profit. Okay, beating that. Okay, so you own a share of Apple. Okay, so I'm trying to teach you guys how this works. Okay, so if I own Apple, okay, well, for example, Primerica, right? Yesterday, this guy talked about the ex-dividend, right? What is a dividend? That means that company had profits and they're giving the profits back to shareholders. So for every one share that you have of Primerica, of 282, right? That's what the cost you to buy one share. They're saying that for every share you get, every share you have, we're going to give you a dividend. You said how much? $1. That's phenomenal, right? That's phenomenal. Think about it. So do the math. I didn't know it was $1. 333 shares times $1. How much is that? $330. $330 they're going to pay you just for having stock, right? So 333 shares times 282. How much is that? About 100 grand, right? Not bad. 3% on 100 grand just for on top of growth, right? 93 grand. 93 grand, right? So 93 grand for at this price. And obviously the stock price can keep growing. I can't wait to do one to 10 split eventually. Because it gets so high, they're gonna have to split it so people can afford it, right? But anyway, so this is what happens, right? So the dividend is the profit you make for having the share. That comes as we had all this profit, let's pay money back to the shareholders. And what that does, it makes it more attractive to people to buy the stock because now they're like, okay, you can be younger and older people look for dividends because that's income for them. Okay, so now they pay a dividend and they pay capital gain. Okay, so continue. Okay, so now let's talk about dollar cost averaging. Okay, so this is where let's call this the floor right here. This line, we'll call it the floor. Right? This line is the floor. Where they say you'll never lose money, right? So now let's use an example here of investor A. Okay, investor A puts $100 a month away, and this is the price right on the side, and this is time. Okay, so whenever you're investing $100, right, a month, and the time frame is 6 months, in this example, if the cost of the stock is $10, and you invest $100, you get how many shares? 10. Okay. The second month, the market grew, the stock price grew. So the ones you bought at $10 today, they grew to $2 more, right? The next month, which is good. And the client's like, oh, I'm happy they grew. But now what you're buying right now, you're buying at a higher cost, right? So the same $100 you're paying, you're investing into month 2. Now it costs you $12, you buy less shares. And the cycle continues, right? Only grow. Only grow. And what's happening is you're buying less shares because the cost is more. Follow me? Yeah. And the stock price finished at 20. So we went from 10 to 20. You bought a total of 42 shares. Okay. 42 shares. If he sells it, $20, that's $840, right? Minus the growth, the purchase price, $240 is what they made the profit. Right. Now, the question is, okay, if they sell it right now, how are they taxed? How are they taxed?
At their current income. Current
ordinary income.
ordinary.
They count it as income. So now they're gonna pay taxes on that as ordinary income. If they're single filers, what income do they need to be at? We just talked about this on Monday, was it? Ballpark, give me a ballpark at least.
22.
No. Income, I said income.
Max income.
Ordinary income for a single filer, what are they paying on average? How much income do they need to make?
48,000.
Huh? 48,000. 48,000. Right? So now, if they make 48,000 and it passed the year and they sell it, what do they pay in taxes?
0.
And how's that classified as?
Long-term capital gain.
Long-term capital gain. After 0, what's the next tax rate?
15.
After that, what's the next tax rate? 20. Have to do reactionary. Know this stuff. Okay? Know this stuff. Okay? The only thing you have to say is like, well, listen, yeah, you get taxed differently, but let me see the income requirement. And you can always check it because that changes all the time. I don't expect you to remember that. Like, oh, is this new income? No, you can Google that stuff, but knowing the strategy is what I'm trying to teach you guys, okay? So hey, listen. This guy made a profit of 240. They're gonna count as ordinary income. If his ordinary income's at 1 to 2%, he pays 22% on this growth. Which is how much? 22% of 240.
$52.80.
He pays $52 in taxes. Keeps basically what 90. It just keeps up $190. Right?
Yep.
Now, investor B or Mr. B, right? Scenario is the same. $100 every month. $100 every month. And the price starts at $10 the same way. They buy 10 shares. But the second month, okay, now the price goes down, right? Instead of going up, it's going down. And now the client's still not concerned yet, but they're buying at a discounted price. They buy more shares. The third month, they're a little bit worried now. They see the market went down again. Now they're buying them at $4, and they're concerned now. 25 shares they bought. And on the fourth month, they're calling because they want to withdraw their money. All right? Because they forgot what you taught them, which is buy low, keep it, don't sell it until you need to sell it. You retire it, okay? But the point is that the client doesn't know or doesn't remember that he's buying all these good companies at a discounted price, about 50 shares. The market starts recovering, and then it recovers again. Okay? This is what we call a flat market. There was no growth. It started at $10 and it finished at what?
$10.
There was no growth in the price of the share. No growth in the price of the share. Okay? Now, how many shares did they buy?
126.
126 shares. Okay? At $10 each. How much is that?
1,000.
Minus $600.
660.
660 is the profit. You see what opportunity cost is? When IUL guys tell you can never lose money. Yeah, but you're losing opportunity cost because you're not losing because you're buying always at a premium or at the floor. But when you buy it when the market goes down, you end up with a better return on the profit, 660. And the cost per share is less. You pay less per cost per share because the average cost per share will be less on this one, on investor B than investor A, because you're buying at a premium all the time. So that debunks the you never lose money. You don't lose money, but you don't get a chance to buy at a cheaper price, which is costing you 240 to 60, 660. How much is that? 480, is it? 420? 420, right? It's not April, okay? So $440 you lost by not being able to buy at a cheaper price. So, Mr. Client, what is better, a fluctuating market or a rising market? Fluctuating market. Okay. So when the market goes down, how are you going to react? It's a good thing, right? You should be doing what? Selling or buying?
Fine.
And you tell this to the client so they know, so they're getting it. So now, when that happens, because they'll forget a year from now, they're gonna be like, "Hey, Omero, the market's my account went down." I said, "Don't worry about it. Remember, I showed you this graph. Okay, what are you supposed to do? Now go over it one more time. What are you supposed to do when the market goes down?"
You go over there like it's Walmart on Black Friday.
Correct. You're buying at a discount, right? So that's exactly what's going on right now. Okay, and remember, I showed you this plan. But now you're experiencing this, right? Where the market is, let's say, 2-year time frame. Let's see. Right now, you're buying right here at a cheaper price. Okay, that's all you're doing, right?
$60 on something.
Yeah. So, Mr. Klein, is it okay if the market go down?
Yes.
Perfect. Right, especially if you're still in your 30s, 40s, and 50s. Now, if you were 60s, whole different things you find. But right now, you want time to grow your assets. Sounds good?
Yes.
And then you would explain on investment, right? Pretty simple, right? That's all I use for the investment. Explain to the client that. But I just show you that's all I explain to the client. I don't show them a whole graphics and chart. I'll print it out, but I'll never go over that with it because they don't need to really know that, right? They're not gonna know the first thing on the portfolio. Like for example, I have a portfolio I give my clients, right? And I'll do this. This is my cousin's illustration when I give, right? So this is all we can print off, right? So this is my cousin, I found out of Kansas, and this is what the company sets up for the client on Morningstar, okay? A growth portfolio. Hey guys, you don't have to put all this. You put the data. You should know what it is, right? It's telling you here that it's 53 U.S. stocks, non-U.S. stocks 32, and bonds 15. This is a diversified portfolio when it comes to having a growth. Okay, growth structured portfolio. Okay, and then here is telling you, for example, breakdowns, right? Like for example, where it's broken down and percentage wise, right? In what countries? Now you don't have to go over that with the client, right? You don't have to go over that with the client.
They're just confusing.
Yeah, you're confusing. Demo it, okay? Toma una serie de minutos, okay? Okay, so then, now here it tells you the company stocks, right, or the portfolios it's going into, or the funds, mutual funds is going into, and the dollar amount. And then there's gonna be a part here that tells you what percentage of the dollar amount is going in there. So we had about $50,000, and 38% with the common stock, American Franchise Fund, equity, international equity, and core bond plus, right? And then it gives you the broke. Now this I do go over, which is all the companies, right, that it's going into. Microsoft, NVIDIA. So here's a sector, right, of where it's going into. So I mean the industries is going into. Here's a ticker symbol. The dollar amount is going into that company, okay? Percentage wise, and the company, right? So Microsoft, NVIDIA, Apple, Alphabet, Amazon, Meta Platforms, Broadcom, Wells Fargo, Bank of America, Philip Morris, right? Now, if you don't know, like for example, Suncor, look, it's an energy, right? It's an American-based company. It's an American franchise fund. Okay, this is the ticker symbol right here, right? It's in the Invesco Comstock Fund. So if you want to know specifically, well, I think it's in Canada. So just Google it, right? Because these companies are changed out all the time. Because if they don't fit the portfolio model, they'll switch them out. Okay. Tells you the industry, right? So I go over just a couple that they might know: FedEx, Chevron, Johnson & Johnson, Eli Lilly, ExxonMobil, Goldman Sachs, Cisco Systems, AIG, right? Don't know that. Citizens Financial Group, don't know that. A lot of people, State Street, one of the investment firms, it's owned by Citigroup. Citigroup. eBay, Visa, Johnson & Johnson, CVS Health, Cisco Systems again, right? And then I go over this part here, right? You put in $51,000 for your client, right? We're going to charge you $2,281, $2,288 to invest with us, right? However, look, your portfolio is going to be at 11% return on average. If you put it in 2009, right, by 2024, what time frame is that? 14, 15, 16, 17 years about, right? Yeah. 17 years, you would go to $262,000.
Might be you 17.
That's a portfolio setup. Because the Morningstar would only go back 17 years because one of the funds was not set up more than 17 years old. So that's why they'll set that up for you. Yeah. So all these funds that I was showing you here, guys, all these funds here, Morningstar will calculate when the earliest they can give you a portfolio solution. Meaning, if the portfolio go back 30 years, it'll go back 30 years. But something like maybe American Franchise Fund was started in 2005. So if they try to give you 2004, showing you something, they can't. So Morningstar is probably saying, one of these, this is an old fund, 1960s, back in 2005. It might be one of these two that goes back only 17 years or 14 years, whatever it may be. Okay. But that's it, guys. That's what I'm expecting to the client, right? And then, you know how it shows the funds? I'll have them like right here. Like, for example, you see up here it says American Franchise Fund. So American Franchise Fund is one of the portfolios that goes in that portfolio solution. So now I'm showing them, look, so this is one of the funds that go in there. And then here goes another one, Comstock. Here goes another one that's in there, right? And I show them this, right? And I show them the diversification of all of them, right? And then here it goes, right? So this is the most recent release of the fact card, it's called. Okay. So the fact card basically is telling the client, hey, this is the most recent data, right? What's the name say it? Take data, right? In 2024, okay? And it tells you here that this has a total of 54 companies or holdings, okay? And then here are the top holdings percentage-wise. So almost 8% goes into NVIDIA stock. So if you put $100, almost $11 goes into NVIDIA stock if it's in this portfolio only, or this mutual fund, I should say. Okay, and then but it has a total of 54 companies. So all these 54 companies go into what? The portfolio I showed my cousin. Okay, so I guess the point is that you have so much diversification because you're going into just this alone is 54 companies. The other ones have more companies and different sectors, right? If you look at Comstock, right? Comstock, this is more financial, right? I mean, it tells you right here, right? You got Wells Fargo, Bank of America, you have some Apple, some other companies. It's not, but this has total 76 companies, so it's not heavy into one company. So, I mean, you're probably going to have 100+ companies where your money is what? Diversified. And why is that? Why diversification so important, guys? Why? What do you think?
Less risk. Like a certain sector takes a hit.
That's exactly why. Because the client's worry is, can I lose all my money? And the answer is?
Yes and no.
Yes and no. Why is that?
Because if every company goes bankrupt, then yeah, but the chances of that happening is not very likely.
Correct. So you can never say, see something up here says this, right? It says here, deposit not insured, not guaranteed by the bank, may lose, not insured by federal government agency. So in other words, tell the client, there's no guarantee, right? You could lose all your money if all these 74 companies go, or 76 companies go bankrupt. Mr. Klein, logically, just think about this. How likely is it for Wells Fargo, Bank of America, Microsoft, Apple, Facebook, Instagram, Snapchat, what's the other one? WhatsApp, Johnson & Johnson, Philip Morris, FedEx, going bankrupt, all at the same time?
Not really.
Can it happen?
Yes.
Yeah.
Yes. But how likely is it for all of them?
Not like.
Okay, so you're kind of correct. Now let me ask you a question. Have you heard of Blockbuster before? Where are they at today?
Wrong.
Have you heard of Microsoft before? I mean, Kmart.
Yes.
Where are they today?
Wrong.
Have you heard of Boston Store? You heard of them?
Yep.
What happened to them?
Wrong.
How about Sears? 100-year-old company, Sears. Gone. How about Radio Shack? How about Toys R Us? Right? There's a lot of big companies who are billion-dollar companies, and they all went bankrupt, and they're no longer here. So my question to you is, okay, did the consumer stop buying just because Blockbuster went out of business?
Wrong. No.
What do they do now?
Streaming.
They stream it. So they went from purchasing physically to
Streaming.
streaming. The people that buy at Sears, where are they buying all their appliances, their hardware from, and the home goods and clothing? Where are they buying it now?
And arts.
Different stores. My point is that people change their buying habits to where they buy it. Okay? So also what happens is that 25 years ago, none of us had an iPhone. That's when it first got released, about 25 years ago. Now, because of 25 years ago, I guess my question to you is, before there was no apps, right? So today, have you ever bought something on Amazon today, Mr. Klein?
Yes.
Yes. Okay. So if you're buying things on Amazon, that means that you're not going to a physical store anymore, right? It's being delivered to your house. Have you ever bought an Amazon before? Have you ever streamed something from your phone before now? You see the habit changed, and therefore the companies changed, right? Google did not exist 25 years ago. Okay? Facebook did not exist 25 years ago. And then if we go back to a lot of other companies on the American Franchise Fund, you got Apple, which was a company that was worth very little as far as stock price. NVIDIA was barely a coming up company. It was probably worth a couple of dollars a share, like $1. Right? Today you can't even buy it, unless how much is $1,000 a share? Or 400?
300.
300? Right? So Mr. Klein, look at this. Okay, so you can agree that there's no guarantee, but the chance of you losing your money is kind of like it's rare, right? And then I'm gonna use this example, Mr. Klein. Imagine you're driving a car on 27th Street and you're going 100 miles an hour, and you're not stopping at the red lights. You're switching lanes without signaling, right? You're on your phone. You're driving with your knee, right? Can you get into an accident? No. Are you guaranteed to get into an accident?
More likely to.
No, you're not guaranteed. Right? You can get away without getting into an accident, right? You can go 100 miles an hour, crossing all the red lights, switching lanes with your knee, driving the steering wheel, right? But it's a higher chance. Okay? When you invest in one single company, right, you have a high chance. But what we're doing is we're driving the car on 27th Street at the speed limit. We have two hands on the steering wheel, phones put away, seatbelts on. We signal when we switch lanes. We stop at the red light. We're going the speed limit. Can I still get to an accident?
Yes.
But how are the chances now?
Less likely.
Less likely, right? So why? Because I'm more aware. I can see things coming because I have time to pay attention to stuff. Well, when you invest in a mutual fund, that's what you're doing. There's still risk, but it's more controlled risk because you're so diversified. So with that being said, look at this fund. 11% return since it started in 2005. Really good. Almost a 12% return plan. Okay? And this is not even an aggressive portfolio. This is not even aggressive, Mr. Klein. 34% last year, or year to date. Last year, 34%. If we go down here, Mr. Klein, look at this. We have, in a 10-year time frame, we have a 14% return. Now, I'm going to go over this year. and I'm gonna go over this year. Okay? And this year here is what I like to explain to the client. Mr. Client, remember I showed you that graph, the marker that fluctuates? If this happens to you, how should you react?
Good. Like, I'm okay.
Right? You should be thinking, this is my opportunity to buy more. Okay? So, because look, if you were to buy here, the following year, how much did you grow?
$70.
This percentage wise.
Yeah. 70%.
No.
100.
From negative 31 to 0 is what? 100.
Oh, yeah.
Oh, true.
140%.
100%.
Because when you down, you recover back to 0, it's 100% recovery. So you missed out on a lot of money if you would have waited because somebody you heard told you right now's not the right time to invest. No, right now's the best time to invest. All right, so that $200,000 check, where is it? For real, like I'll tell you this. No advisor out there is gonna do this. First of all, they don't know how to explain what I just did. A lot of them don't. Let alone how to strategize for them. And if you learn how to do this, guys, you get $30, $100, $200,000 checks, but you gotta get yourself an investment license. You gotta get yourself an investment license. Cody, if you do, okay, let's say that guy who was on the side called how old is he?
26 years old.
26 years old, makes 200 grand, only doing investments. Right? So now, let's say, I'm gonna tell you so Cody, this is you, RVP, okay? Listen to me here. Your contract will be 62% on the sales you make, right? So that's what it'd be on the security side. It's a little bit different on the security side, but that's how it works. Let's say you write every quarter, you do, let's see, 2 million. Times 4 quarters, that's $8 million in securities transactions you did. Because people that don't have money know other people that don't have money, right? And if you're able to learn the securities industry like this, 8 million times 5.5% return, right? 5%, just do 5%. 8 million times 5%.
400 grand.
400 grand, and then from there, okay, 62%.
$248,000.
$140,000. Just doing some securities transactions. $2 million. That means you have to find, so $2 million every quarter, okay? $2 million divided by 3 months. Do the math?
650.
2 million by what?
Divided by 3.
660.
660. Okay, so 667, right? 667, right? Yeah. Okay, so you need to find at least 3 clients that have about 200 grand, or 6 clients that have 100 grand to roll over. And if that's your focus, right? Hey, Mr. Client, I help you out. Who else do you know that can sit down with that you do the presentation? Everything we do for the client, we do this, and you have a conversation with them. You start building a network. Sometimes we have 200,000, 300,000, 400,000 to roll over, and 240. It's not that complicated. We just gotta get good. If we got more people securities license, we would do a lot more securities trades. This is fun. I love investments. I love it. I just love explaining it to the clients. I love learning, teaching people. And one thing I found out is that people that have money, it's a lot easier for them to understand this. Okay, so we do have money. Yeah, they have a little bit more choices because they're like, well, I've been working with my guy for years, but still, when's the last time they met with you? When's the last time they sat down with you to go over this? Have they explained you this? And you start teaching and educating them. Now they're like, shoot, I never knew that. Right? So, guys, we're gonna wrap up. I have somebody that I'm supposed to meet with right now. But yeah, cool. Awesome. Don't need the flashlight.